Hey there, everyone. Welcome back to another episode of Wealth Breakdown. Got another practical case study for you here that should apply to lots of business owners. And this one is it's easy to implement if you've got the right folks and if you've got the right attitude. So let's just jump right into it. So here's a brief overview of the situation we have today. So we've got Jim, who is in his late 40s. He's got two 12-year-olds. He's married and he owns a manufacturing company. So what we ended up doing with Jim in this scenario is he pays his kids to do cleanup of the admin building of his manufacturing plant. We can't have the kids in the manufacturing plant. That'd be dangerous. But the moral of the story, and I'll get into details, but just to give you how powerful this is, this ends up costing Jim, who pays the kids $8,000 each, and it is going to result in somewhere around $2 million in today's dollars for each kid by the time the kids are retirement age and they get to take that money out tax-free. Sounds pretty good, right? Okay, so let's get into it because this is not without its nuances, but there are only a couple. So here's how this works. So first, we need to briefly cover the best practices for paying your kids and why it is so powerful. So number one, we have to go through the pitfalls. So if you listen to what I just said before, you said, okay, that sounds easy. Like it can't be that easy. You're right, because if you're going to pay your kids in this method, they have to do real work. So you can't, have a 12-year-old charging $500 an hour for legal advice. That's just not realistic. And you also can't pay a kid $500 to like organize your office. It's got to be real work. It can't just be, hey, like pick up some trash like around my office and I'll pay you $1,000. It cannot be that. So they have to do real work that has comparables analysis done to it. So in this case, we looked at what are rates for cleaning. Then we thought about, okay, well, but a 12-year-old is definitely not going to do as good of a job. It is something that a 12-year-old can do and passes the smell test, unlike, okay, 12-year-old is going to write a very, very good memo that you would pay for on the state of the manufacturing industry. That does not pass the smell test. A 12-year-old pushing around a mop and a broom does. Then we thought, okay, well, then let's have it pass the smell test even more with, okay, now let's take that rate for a commercial cleaner and then let's cut that in half, cut that in a quarter, cut that way down, to find something that is more akin to your, kid that mows lawns type rate. The other things are you have to actually do tax reporting for them. So you have to give them, a 1099. You have to set all that up with either your payroll or however your business works. So why this is so valuable is because the kids are working and because you've given them tax reporting, they now have earned income. However, because that earned income is lower than the standard deduction, your kids will have to file for taxes. But if you have a good CPA, that should be very easy. They should help you set this up. They don't have to pay any tax on that because the standard deduction just covers it. And they also have earned income, so now they can contribute to a Roth IRA. It is worth mentioning that there is tax deductibility for this expense for Jim. It's minor, but it is deductible, so take it. And then when you look at, okay, just simple time value of money calculation, if we have $8,000 per year going into each of these kids' Roths, with an annual investment return of 8%, which is historical for the S&P 500. You look at tax-free growth, number one, and then number two, over time until retirement, you're looking at hundreds of thousands. If we're talking 60, 70, you're potentially talking 1, 2, maybe even 3 million, depending on how the market works, and all for 8,000 a year. So it's a very, very powerful strategy. It is not one size fits all. Every situation is different. In this case, we just happen to have a number of factors line up, but it can work in all kinds of situations. It also may not work in some situations. So let me know if this is of interest to any of you. I'm always happy to do some free analysis to see what works and what doesn't. If you found this valuable or applicable, please click the Contact Us button below to answer a few simple questions and get scheduled with a Bloomwood advisor to discuss your unique situation. The information covered and posted represent the views and opinions of the guests and does not necessarily represent the views of Bloomwood. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for financial, legal, or tax advice. Always seek the advice of your financial advisor or other qualified professional with any questions you may have. Bloomwood is a Georgia and North Carolina registered investment advisor with its principal place of business in Atlanta, Georgia. Bloomwood and its representatives are in compliance with FINRA and state regulation in the states where Bloomwood maintains clients. Bloomwood may only transact business in those states in which it is registered to do so or is exempt from registration. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same result. This content does not constitute tax advice, legal advice, or financial advice, and does not create an advisor-client relationship between Bloomwood and the listener. This case study is designed to give you an overview of the impact that proper tax and financial planning can have on your financial life. The figures in this case study are not calculated to the exact penny and are designed to facilitate a conversation. Thank you.